Good morning. It's Thursday, the 14th of November, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming from Mumbai, India's financial capital. Before we start off with our top stories and themes, there is no take. Friday, November 15th is a holiday, and therefore there will not be any edition, and we'll see you back over the weekend and then, of course, on Monday. And that brings us to the top stories and themes. The stock markets are now down 10% from their peak. Oil at $45 a barrel, and what that means. Foreign institutional investors are not the only ones selling heavily. What is driving the selling, and could it turn? Decoding India's multiple economic headwinds, slowest government spending in several years, and potential trade shocks in a Trump presidency.
This is a core report with Govindraj Ethiraj.
The magic correction figure is here. Well, 10% was that magic correction figure, a fall from the peak, at which point investors would theoretically start relooking and revisiting stocks. Now, will that happen? Well, it's possible, but we obviously don't know for sure right now. So things might change in a month's time or maybe in January, but that's speculation for now. We have lots of interesting insights today in this insight-heavy edition of the Core Report coming your way with two of our guests, Gautam Trivedi of Nepean Capital and Garima Kapoor of Elara Securities. Before I get into that, the Nifty is now down 10% from its 52-week high of 26,277. The Sensex has lost over 8,000 points from its peak, as slowing earnings have led to most institutional and smart investors taking out profits. What smart investors means, we will find out shortly. Reuters said that the Nifty's biggest slide in nearly 6 weeks is now taking it 10.3% below the record high it hit on September 27th, confirming that the 50 stock index is in technical correction. As Gautam Trivedi, who joins us later, points out that in some of the top 1,200 stocks or so by market capitalization, 700 stocks have fallen by 20% already, and another 400 have fallen by 30%. Of course, once the market starts falling, some of the bear calls also start rising. Macquarie India, the Australian investment bank's head of equities, told CNBC TV18 he expected the Nifty to fall another 10% in the next 3 to 6 months, despite the benchmark already correcting 10%, as we pointed out, which would, of course, mean about 20% from peak if I interpreted his arithmetic correctly, which would also mean that the benchmarks or the benchmark indices and the stocks within them would align with the broader market, which Nepean's Trivedi just told us about or will tell us about. The Macquarie analyst said, importantly, that the post-COVID-19 euphoria is now behind us and the markets are now more normal. It's not only just earnings that are disappointing, our valuations are definitely very high, and you cannot always be a cheerleader to the markets waving pom-poms and dancing just because the market is going up, he said. Well, meanwhile, on Wednesday, the BSE Sensex and NSE Nifty lost ground for the fifth day. The Sensex closed down 984 points at 77,690, while the NSE Nifty 50 was down 324 points at 23,559. The broader markets were down sharply as well. The Nifty Small Cap 100 and the Nifty Mid Cap 100 are down close to between 2.5% and 3%. Elsewhere, if you may recall, we celebrated India's overtaking China on the MSCI Emerging Markets Investable Market Index. That's, of course, reversed now. At the end of October, China's weight in the key emerging market gauge stood at about 24.7%, up from about 21.6% at the end of August. India's weightage has now gone from about 22.2 to about 20.4. So basically below China once again, according to Business Standard. The change in that pecking order obviously comes amidst that sharp rally we've seen in China, also driven by investors moving from India to there, and I'm sure from elsewhere, also driven by aggressive stimulus measures by Beijing to support the economy. The only good news, if so, was that the rupee has finally steadied after falling consistently for some days and has now closed at 84 rupees 37 paise as compared to its previous closing of 84 rupees 39 paise. On Tuesday, it had hit a low of 84 rupees 41 paise. Oil at $45 a barrel. Now, this might sound surprising, but it is not in the realm of impossibility. And of course, it is not the first time it's being discussed, at least in the last 3 to 4 months that we've been talking to oil analysts, what engines notwithstanding. Oil prices could see a drastic fall in the event that Oil Alliance, the Organization of Petroleum Exporting Countries, unwinds its existing output cuts. According to market watchers who are predicting a bearish year ahead for crude, CNBC reported, quoting analysts saying that there is more fear about 2025's oil prices than there has been since any year I can remember since the Arab Spring, according to that analyst. The analyst also said that you could get down to $30 to $40 a barrel if OPEC unwound and didn't have any real kind of agreement to rein in production. They've seen their market share really dwindle through the years, they added. A decline to $40 a barrel, which of course is great news for countries like India, would mean around a 40% erasure of current crude prices. Global benchmark crude is currently around $72 a barrel, already soft. The head of Energy, Climate and Resources at Eurasia Group told CNBC that given that oil demand growth next year probably won't be much more than 1 million barrels a day, a full unwinding of OPEC plus supply cuts in 2025 would undoubtedly see a very steep slide in crude prices, possibly towards $40 a barrel. To me, this once again poses the question of how the United States could benefit from drilling more oil, a key Donald Trump campaign promise, assuming, of course, the oil majors want to actually drill more oil. Another analyst said that should OPEC Plus unwind cuts without regard to demand, it would effectively amount to a price war over market share that could send oil to lows not seen since COVID. What might actually happen, the same analyst said, it of course is a gradual unwinding early next year compared to a full-scale and immediate one. So let's see. Looking at the recent selling in context. So what is really happening in the markets and what are the intertwining forces of slowing earnings, supply of funds into the market and smart investors telling us? How can we look at quarterly earnings over the last couple of years in context? And what's the story behind those numbers, including a closer look at earnings of those companies? And finally, what is keeping markets where they are and could they turn? And if so, when? I reached out to Gautam Trivedi, managing partner of private equity fund Nepean Capital, and I began by asking him why he was seeing the kind of selling that we saw by foreign portfolio investors.
Yeah, so let's look at where the market peaked on the 26th of September. We saw the market, the Nifty 50, that is, benchmark index, peak at about 26,260. And that's been about roughly 6 weeks since then. So the total amount of money that's been sold by foreigners since then actually is $15.5 billion. Now, if I look at this in the big scheme of things, foreign portfolio investors, FPIs, own roughly about $1 trillion worth of India's $5.7 trillion in total market cap. So that's about 17%. Now, if they've sold $15 billion, we're looking at only 1.5% of their total holdings. So the absolute amount isn't really that big. That's one. Over the past 6 weeks, we've seen domestic mutual funds almost matching the buying. So what that means is that even though the domestic mutual funds matched the quantum of selling that came through from foreign portfolio investors, the market fell as much as 8.5% to 9% over this period. So that tells you there's a third factor at work, which is basically the high net worth and family office pool of capital, which has also been selling into the market. Otherwise, if the selling and the buying are almost matching, you can't have such a big fall in the market. So I think that's where we are with respect to foreign flows.
So you're also saying in some ways that the smart investors are selling into this market.
They are selling into the market. They have been actually selling for the past several months. I know some of the funds that are sitting on as much as 30 to 40% cash, and they've been sitting, unfortunately, for a longer time and in the hope that correction would happen earlier. But clearly that correction's taken longer, but it's finally happened.
So what does that say then about the institutional investors who are buying at this time, while, let's say, the smarter investors are selling? Because it seems to me that then there is one class of institutional investors who may not be acting in the best interests of their own investors.
You make a fair point, Govind, but the fact is that look at the quantum of money that's coming in month after month. We've seen 44 consecutive months of positive inflows into domestic mutual funds. And that number only seems to be going up every month. So we got the numbers yesterday only for the month of October, which were a staggering 41,000 crores. So that money is still coming in uninterrupted. 25,000 crores of that were the SIP numbers, which again was a new record. So I think given the flows that are coming into domestic mutual funds, their ability to stay in cash for too long is very limited. Hence, they have to deploy. If I was in their shoes or if I had flexibility to stay more in cash, I would do so. But I don't think they have that luxury, unfortunately.
Right. So if you were to think about now the Indian market, we've always been saying or have been saying for some time that markets are a slave to earnings, or the rise in the market is a slave to earnings. Now, if the earnings are declining, as we've been now starkly seeing in recent weeks, where does that leave investors who want to take a more, let's say, rational call, valuations and stocks?
So, you make another valid point with respect to earnings and the market following earnings. But what we've seen over the past 12 to 15 months clearly is the fact that it's not earnings that's actually driving up the market, it's fund flows. Now, what's driving the fund flows? It's not, as we discussed earlier, it's not foreign portfolio investors, it's been domestic investors. And what's happened really is over the past about 3.5 to 4 years is that the quantum of ownership in the equity markets as a percentage of household savings has gone from sub 3% to almost 5.5 to 6%. Now, that's also been propagated to a great extent by the advent of smartphones, 4G. As we know, Reliance Jio rolled out an all India only 4G network. We've got now over a billion people that actually have phones. We've got eKYC. We've got literally the market in your palm. You can buy and sell stocks while you're on a train. You can buy and sell stocks while you're on a beach, pretty much. So the financialization of the Indian equity markets really has spread over the past 3 to 4 years, and I think will continue to do so, or at least over the next 5 to 7 years. So when you see that happening and newer people coming into the equity markets, and the fact that 44 consecutive months of continuous, fresh, positive inflows into the domestic mutual funds and money coming directly into the equity markets as well. So that phenomenon really has been driving the markets. It's not necessarily been earnings. In fact, to your point on earnings, this quarter has been probably one of the worst quarters in the past 3 years. So I have some data which I wanted to share with you, which is quite perplexing. In the last 3 years, and we're currently looking at earnings in FY25, second quarter FY25. If you look at the same period 3 years ago, exactly the same period, second quarter FY22, and this is the universe of the BSE 500 stocks, sales growth in second quarter FY22 was as high as 25.7%. That's fallen down to 7.6% in the current quarter. And again, caveat here is that the current quarter, all the results haven't been declared. Second element is the EBITDA growth. EBITDA growth was as high as 13% in the second quarter FY22. We're now down to 1.2%. And the net profit growth, that's a big one. It's gone down from 38.6% to a negative 5.3%. So clearly earnings struggling, but we're still seeing record inflows. So how do you marry the two? And to your point, earnings are not leading fund flows from domestic investors. It's basically the financialization of the markets that's causing more money to come.
I'm going to come to your sort of larger outlook going maybe a month or two ahead. But before that, how are you as a fund seeing this period, and what are the kind of themes that you're looking at?
So, we are seeing period of correction, which I think not just us, but a lot of people in the market who've been around for several decades investing in India have been waiting for. And the good news is that the more the market falls, the cheaper it becomes. And as a result, the interest both from domestic and foreign institution investors actually comes back pretty significantly. I see that happening maybe sometime early next year when foreigners will definitely come back. Other point I want to make is specifically on the foreign portfolio investors. And again, they didn't do much until September. But after September, you saw the selling that suddenly accelerated. Of course, part of that was also caused by rally in China. So India became a funding market where they sold India, put money into China. The other element which I want to focus on is the fact that if you look at the domestic market back in the US, the S&P 500, for example, has next year's earnings, calendar 2025, 13% earnings growth, 1-3. A lot of that, of course, is driven by the Magnificent Seven. But the reality is, if you have 13% earnings growth back home, would you have interest in putting money to work in an emerging market? And that's something to think about.
That's interesting, because I was actually going to ask you that, interest rates have been falling, and including by the Federal Reserve just last week. And despite that, usually when that happens, people expect more funds to flow into emerging markets, equities. So you're saying now that there is now a sort of tension between the two. Wanting to invest in emerging markets versus back home.
Here's the thing. If you look at the S&P 500 earnings for last quarter, and even there, the earnings haven't fully played out. As of this Monday, 84% of the S&P 500 companies had declared results. Net income grew as much as 8% year on year. So pretty strong numbers. And this doesn't include Nvidia, which declares on November 20th. The other element is of the companies that have declared results, 51% have actually beat analyst forecasts. So the US economy is still raging and is still pretty strong. There's a lot of expectation of what President-elect Trump will do with respect to further bringing down inflation, creating more jobs. So I don't see the US stock market cooling down at any point of time in the near future. And I think that in some sense does end up becoming competitor, if I can call it that, to emerging markets where foreign institutional investors will want to park their money.
Right. And last question. So are you recommending now a more diversification of assets as opposed to, let's say, only now choosing within equities?
I think the way to look at this is I've been a fan of the equity markets for the past 30 years, and that's not necessarily going to change with this one correction. But my advice to people is, and we track screens across various sectors, but if you look at the top 1,200 stocks sorted by market cap, since the 26th of September, we've seen 770 stocks that have had a correction of 20% or more. 400 stocks have corrected 30% or more. So I think it's time to start tracking some of these companies. I'm not saying they're all necessarily buys, but the fact is you'll start seeing companies that are clearly emerging as attractive, and they will be buying opportunities, I think, starting early next year. So that's what I would keep my focus on.
Gautam, it was a pleasure talking to you. Thank you so much.
Thank you.
Decoding the macro trends. Staying with decoding the markets, let's take a more macroeconomic angle. It's quite evident that Dalal Street and Wall Street have diverged in their paths, which was not the case until September 27th or barely 6 weeks ago. What are the macroeconomic factors that are driving this divergence? And while we've spoken of corporate earnings, what are the signals that we're seeing from government spending and the slowing of it, and how much is that? The numbers will surprise you, by the way, the slowing numbers, that is. And finally, from what we know today, what will be the impact of higher tariffs by a Trump presidency on China and other countries, including, of course, India? Remember, India also imports Chinese components for products like iPhones made here and then exported to the United States and other countries. I spoke with Garima Kapoor, economist and executive vice president at Elara Securities, who's been studying this issue closely. And I began by asking her to speak about how and why the stock markets were moving the way they were between Wall Street and Dalal Street.
I think this trend of Indian markets probably being in the choppy territory started when the talks of Chinese stimulus started, so way before the result of US elections. Suppose that while outcome of Chinese policy announcement has not been very robust, the outcome of US elections has given a further thrust to rotation of money away from EM, particularly into US. So when we were looking at the EPFR data, which we track on weekly basis, the flow of funds into US started to gather pace nearly 5 weeks before the US election. And India in particularly, since the US election, we've seen a loss of about, since 5 weeks in particularly, a loss of about $575 million flowing out of India. The most US domiciled funds, as well as European domiciled funds, have been pulling money out of India. And this partly explains what's really happening. Now, why are the US markets so happy? What is really that they're celebrating even before Trump has taken up the presidency officially? Clearly, in the previous term of Trump, he did execute a series of tax cuts, particularly a corporate tax cuts that partly flew into your bottom line, that led to huge buybacks. If you look at the data of buybacks between 2017 and 18, the increase in buybacks after tax cuts was more than 350 million US dollars. Most of that basically translated into higher share prices. The expectation is that this year will be similar because one of his campaign promises was reduction of corporate tax cut by 21% to 15% for domestic funds. And he's promised some other cuts, especially in terms of incomes, in terms of overtime income and otherwise. So there is a general positivity or euphoria around what he is going to start executing. Second, he's also announced a lot of deregulation. Now, we really do not know what that deregulation clearly means because he's not spelled that. But any deregulation that helps to counter the cost pressures is always welcome and flows on the bottom line of companies. So this partly explains what's happening to the global markets, particularly US. But in case of India, something very strikingly difficult has started in terms of earnings downgrades. The consumption slowdown is pretty evident from past quarter or so, or I should say more effectively about past month. Second is government spending, particularly on capital expenditure, has been extremely sluggish, degrowing at about 12% FYTD. I think the last time we saw such sluggish growth was maybe more than 7 or 8 years ago. And third, we were anyway overvalued and probably an expensive market. So a lot of froth in the market is probably getting corrected. Now, if I mix into all of this, and we were just looking at the earnings data of NSE 200, more than 54% of the companies who have declared the results so far have given a misses on their earnings vis-a-vis what was expectations. So I think it's a combination of what's happening domestically plus what's happening globally, especially led by US election, Trump victory out of US election.
So you said government expenditure has slowed down to levels last seen 7 to 8 years ago. That seems pretty high. I mean, even accounting for, let's say, a pullback because of elections and all that, what you're saying is that the rate of growth at least has gone back several years.
The rate of growth so far this year, we have data until first half, is degrowing at 12%, government capex expenditure in particularly. Now, what normally happens, Govind, is every election year, especially if you look at the past 2 election years when this government came to power, sees an underspending or underachievement of capex target. Now, what has happened is because you start off on a weak note. Now, normally we've seen an average underspending of 5 to 6% vis-a-vis the budget estimates. But this time, the slowdown has really baffled a lot of people. Remember, a large part of rally in cap goods stocks in India and industrials was all led by government spending. So that is really making people rethink their expectation whether this is an intent problem or it is an execution problem. Because when government came to power in the month of June 4th, they still had only lost out about a quarter in terms of momentum spending. They could have recovered well during July, August, September. July saw a recovery, August again saw a slump, September again saw a mild recovery. But when you start off on a very weak note, it's too difficult for you to catch up no matter what your intent is. So you are going to see underspending no matter what. So some of these industrial stocks and cap goods stocks, particularly PSUs, are repricing this phenomena in terms of slowdown in government spending.
Right. And question. So trade obviously is the big discussion point right now. And incoming Trump administration is talking about a 10% tariffs on most countries, 60% on China, maybe some other tariff levels for other countries. What could this mean from an India point of view at this point, given what we know or we can potentially project?
See, broadly, tariffs as a policy measure in the past also have taken about 8 to 12 months to execute. So what I'm going to talk about is more a phenomenon of, let's say, calendar year 2026 rather than calendar year 2025. Now, in case of India, it has multiple repercussions. One is that China's presence in global supply chains, especially in terms of capital goods, and India's dependence on Chinese capital goods clearly means that the disruption that China will see, it will have its ramifications on India as well. We were looking at a data of close to 4-digit HS code wherever India exports more than $100 million worldwide as an annual number. Nearly 68% of those commodity classifications as per 4-digit HS codes have seen Chinese import intensity increase. So we are going to see a disruption even if China faces tariff, number one. Number two, this time the tariff will not be directed only towards China, but also towards countries which are pseudo-Chinese producers, like Mexico, Cuba, Vietnam, etc. So the supply chains will probably see a double whammy vis-a-vis what they saw in the first presidency of Trump. The third and most importantly is that in case of India, and not to forget, we have been target of Chinese dumping for nearly 2 years since post-COVID Chinese recovery faltered. And we are still grappling and we're not able to come to terms with it. All this is happening at the time when India-China rapprochement has started all over again. So our ability to be able to use tariff walls or import duties against China will also have to be reflected in the light of our recent bonhomie, or I should say, the recent warmth that the relationships are trying to gather again. So I think from India's case, we'll have to look at an inflationary US because the retailer is going to pass on prices. That means we'll have to look at a hawkish Fed. That means we're looking at probably very shallow rate cuts even in India in the backdrop of that. We're looking at a scenario that's going to disrupt supply chains. And also for economies like India, particularly the exports to US, which have Chinese components as an important component input, will also see disruption. That partly explains why some of these solar producers or some of these energy companies have been seeing some bit of a correction, because we do anticipate some bit of impact to come on India directly as well as indirectly, because we import a lot of imports from China, then add value and then export to US. So I think it's going to be a bit of a disruptive cycle, something that we've not seen in the past. But I doubt that Trump will actually impose the tariffs to the extent at which he has indicated in his poll campaign. Partly because, remember, US's dependence on critical mineral supply chain from China is very high. It's a trajectory that we will have to look at in the light of evolving geopolitics, which are completely different now than what they were in 2017 when he came back to power last.
Right. And just a small supplementary question to that. So you're saying that if, for example, let's say Apple makes iPhone for which it imports parts from China and then assembles them here, iPhone 16, exports them to the US can capture imported component within that. For example, the Chinese imported component within that.
See, it won't be able to capture the Chinese imported component, but what would happen is that if import duties are put on China, especially on certain mineral, because China still does not produce this PCB, it does import from other countries, then the cost of those inputs in China is also going to go up. So when we are importing out of China, we are also going to see its ramification on our onward exports, which does use Chinese inputs or intermediates.
Got it. Garima, thank you so much for joining me.
Thank you for having me.
And finally, before we go, here's some feedback. Remember, just to remind you, we do not have an edition tomorrow because it's a markets holiday. Okay. Abhishek Jain says, I haven't found a better detailed daily brief on the markets. Please don't stop. Thank you. Nalini Chandrasekhar says, MTNL has purposely brought itself down over the past 3 decades. It was only standing because of our senior citizen parents living away from us who didn't pick up mobile calls. It should have been liquidated long back when they had loyal customers. Is every PSU divestment only worth the property they own with public money? This is, of course, a reference to our take on why MTNL should be unwound or liquidated and money returned to everyone, including the government and shareholders. Okay, on Tuesday, we put out a report saying that the markets flounder again, which they did, and we asked why are they failing in the headline. A.B. Lavre, a very astute watcher, has clearly pointed out that why have you put a headline if you have no intention of addressing it? Well, we did point out why the markets are falling, but perhaps we didn't go into the detail that you were expecting. We apologize for that, and we will be careful next time. Clay Madness says, hello, Govind. I wanted to mention, unlike the comment you received, I'm very glad you guys don't venture into providing tips and predictions, unlike the gazillion YouTube channels out there who, in my opinion, just further speculative activity. I think people over time have forgotten what journalism is supposed to be and how it's different from running a YouTube channel or podcast. As a former journalist myself, this channel is a fantastic bridge between the old and new media ecosystems. Clay Madness, thank you very much for your most encouraging comments. It encourages us to stay grounded and keep putting out information and some opinion, but definitely not tips and predictions. Thank you very much, everyone, and see you with our weekend edition then, and of course, on Monday, back with our news. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.